In this video, we're going to talk about cash flows and some financial planning issues. One of the critical tasks of a financial manager is to develop an understanding of how cash flows are created within their company. So we need to have an understanding, number one, how you calculate that, but also how can you plan for that, right? We need to have a strategic plan that's going to help us move forward in the company. So within that strategic plan, there are things we'll need to buy. There are things we'll need to sell. We need to plan for paying interest on loans and dividends to shareholders. So this is really a very critical piece of what a financial manager does on almost a day-to-day basis, if you will. So in this video, we're going to talk about several things. We'll talk about long-term, short-term financial planning, statements of cash flows, how we calculate cash flow, right? We'll explain how we use this within the business process of planning for short-term cash and for long-term types of financing questions. So the financial planning process starts with long-term or a strategic kind of a plan, right? This is a plan that's going to help guide the operations of the company. So you start with long-term and you work your way into short-term management of the company. So the two aspects of this are cash planning, which is the preparations of cash budgets, and then profit planning, which ultimately involves the preparation of pro forma financial statements. And obviously we'll talk about those in a little bit more detail. So a long-term financial plan lays out the strategic plan, if you will, of the company. Typically, they're going to range from 2 to 10 years. 5 years seems like the norm in most businesses that I've seen, right? But what we need to understand is that these are obvious predictions. So there is a lot of uncertainty in developing these long-term plans. And if there's a lot of uncertainty in the 5-year plan, there might be a fair amount of uncertainty in the shorter term plans as well. So we want to consider a number of things, right? These really all relate directly to the strategic plan of the company. What are the proposed fixed asset investments? What do we need to buy and or what do we need to sell? Research and development activities, product development, capital structure, and what do we want that to look like? And then once we know what that is, we also need to have some planning on how are we actually going to go out and get this money. So what are the sources of financing along the way? Short-term plans are a little bit simpler, right? Essentially, we just need to predict, typically on a monthly basis, what do we think the cash inflows and outflows are from our business. And of course, since we have a short-term history, right, we maybe have 2 or 3 years in the past history that reflect a pattern, if you will, of cash flows. We have some fairly decent predictability of what we think will happen in the end to cash flows as we develop these plans. So let's first start talking about pro forma statements, right? These are obviously projected. We're going to forecast income statements, balance sheets. In the end, we actually could even predict cash flow statements. Now, the inputs required, all right, are fairly simple, right? We need last year's financial statements, maybe even the last couple of years' financial statements. We need a sales forecast, and we need to make some assumptions about a number of the characteristics of our business. So we're going to look at this for a company, and we'll kind of follow through and try to explain the process as we go along. So let's think about the financial statements. So we need to start off with last year's financial statements. So here's the income statement from last year, and here's the balance sheet from last year. Now, I will tell you that these are simplified, right? Not every line item in a financial statement is here, but they are simplified. And there are some plug figures that help us with the, so we can get this thing to balance correctly, right? So the idea here is that we have data from the last year. In fact, we could have maybe 4 or 5 years of history. And this might become important as we kind of try to think of how these line items change when sales change. So a simple method of this pro forma statement basically says that if we look at history, right, we can use what's referred to as a percent of sales method. If sales are going to change, is there a relationship between this line item and sales? And if so, what is that relationship? So maybe we say the cost of goods sold, right, that product has historically is averaged about 60%. So what will the gross profit margin be? Well, if on average it's going to be around 40%. So now we can plug these ratios in, these averages that we're aware of, we can plug them into the spreadsheet so that we can develop these financial statements moving forward. Now, one of the things that we need to kind of keep in mind is if we think that things are going to change. For instance, we've been preparing a new site on our property. We just have a new building. We've been building this for a while, and this is going to take our old production line, and we'll move our production to this new line, and it will actually reduce our cost of goods sold by 75%. So now we're only going to have, instead of having 60%, maybe we're only going to have around 20%, right? So we can plug these numbers in. Again, since this is a forecast, we can incorporate what we think is going to happen. Now, part of this is also what's referred to as a judgmental approach. That is, we can assume that certain things will happen based on some of our earlier predictions. So part of our financial statements will be this percentage of sales method, but there is also a couple of line items, as I've already mentioned that we're just going to use a plug figure, right? We'll find a number that fits to make the statements make sense. And those plug figures in the end can help us understand the process and what we need to do to move forward. So here's some data that we need to know, right? From the income statement, we need to know something about what is predicted sales growth. What is the average cost of goods sold that's variable? We have 80%. Other operating expenses, 10%. Is there any extraordinary income? Is there any interest income as a percentage of sales? What's the taxes as a percentage of earnings before taxes? Dividend payout ratio. How are we going to distribute profits? And again, we have some other line items that are in there just because, things can happen and companies can plan on some of these things. So we want to incorporate that. On the balance sheet side, we need to know about some financial ratios. Tell me something about days sales outstanding. That's accounts receivable. Days carry inventory. Days payable outstanding. These are ratios that I can get when I'm analyzing my company's financial statements? What is the company's average cash as a percentage of sales? What is the current ratio? Again, another ratio that we can gather. What's the current market price of the stock? Now here's something that's a little bit different, right? What is the asset capacity? If you think about this, this is really asking me how much of my assets are actually being used, right? So 100% capacity would mean that the building and its product and its equipment is being used 24/7, right? So if there's any increase in sales at 100% asset capacity, by definition, you must buy new assets because you can't make more stuff if there's no time during the week to make it. So this is just a picture. Sometimes we'll have maybe some ratios that could help us with this, but this is asset capacity. In this case, we've estimated it's about 85%. The target fixed asset turnover ratio just talks about, our use of our plants and equipment and whether we're being efficient. But in this case, it's going to help us guide to whether we need to buy assets or not. So in this case, if you look, it says our current fixed assets are $81,000. Our required fixed assets is $104,072. So we need, just by definition here, we need to purchase more assets. And you can see that that's roughly, let's say $20,000 roughly. So what I've done here is I've actually input an asset purchase. We're going to purchase $30,000. So the amount that we have then is 81,000 plus 30,000 is going to give us 111,000, which is more than 104. That's why this says no, right? So before I put this $30,000 in here, that thing said yes. Says, look, you need to think right now before you go any further. You need to buy some assets. So you better figure out what that cost is going to be. So that's the data that's used to input to create the financial statements themselves. So now the spreadsheet that we're using here, again, this is the pro forma analysis spreadsheet. This spreadsheet, by the way, it's also part of the financial statement analysis worksheet. Now, we're not going to go through and do this physically, right? This is just pictures so you understand. Number one, there is a place on the worksheet for you to do financial statement analysis, but also we also just are doing this for an illustration to see how the process works. So what happens is the spreadsheet creates an income statement. It's based on those ratios and how they affect the line items. Now, one of the things I want you to kind of keep in mind here as you look at this, and I'm going to expand it a little bit so it's a little easier to see, right? So if you look at this spreadsheet, you'll see that interest, EBIT, is $10,000, and interest expense is $1,000, and that doesn't change. And the reason that doesn't change is we don't know whether we need to gather more money or not. So this is what they refer to as the first approximation. So it goes through the statement. It doesn't change interest. Those things stay the same. And then it calculates a statement. So we predict at the end of year one, next year, we should have $10,625 in net income. We then create the balance sheet. And again, it uses the data we have above, creates our balance sheet. Now what you'll see here is total assets predicted for next year is $129,000. But when you look at liability and equity, it's only $109,000. And this is really one of the really nice things about this this process, is it tells us you need $129,000 worth of assets, but you only have $109,000. How are you going to get the other 29,000, roughly 20,000? There's $19,522 that we need to gather. Now, what the company has done historically is their ratios, our capital structure, 23% is debt, long-term debt, and 76%, almost 77% is common equity. So now we have to decide, do we want that capital structure to stay the same, or do we want it to change? So now we see we want to change our capital structure. We want it to be 10, 20, and 70. So we want notes payable, our short-term debt, to be roughly 10%. We want notes or our bonds payable, a very long-term debt, to be around 20%, and common equity to be 70%. So based on that $19,000, this is how that is going to be financed. What are the costs? Well, the costs that we need to know are the costs of what does it cost to borrow short term, here about 3.5%, and our bonds cost roughly 7%. So this is our change in interest. So now if we go back to the income statement, we go to the second approximation. Now here is the total interest that we had to spend for this first year's interest based on changing our financing. So you notice interest changes. So now our net income goes to 10,451. And of course, we also recalculate the balance sheet. So if we look at the balance sheet, we see we get to the bottom, and look, there's still $80 that we still need to distribute somehow. Here are the changes in the capital structure that we had predicted, right? We still need to do $80. So again, what it does is it redistributes it, shows us how that's ultimately going to affect our balance, our income statement. So the third approximation is $10,450 in net income. And if you look at the bottom here, we have now distributed this entire $19,522 has been distributed throughout the balance sheet, also affecting interest income, right? Interest expense. So now we have a balance sheet that balances. So this third year approximation here, this is what we predict the balance sheet to look like next year. The previous slide, that's what we predict the income statement to be next year. Now in this worksheet, if you do take a look at it, there are actually 4 years. Sometimes it takes more than 2 changes here to actually distribute all of this money, especially if it's big numbers and interest is a large number. Sometimes it can take a few different iterations, if you will, to get to the final balance figure. But the idea here is we need to predict what we think next year's financial statements will look like. So however they're prepared, right, we obviously need to know how to use them, right? We can use these pro forma statements to look at inflows and outflows of cash. We can look at the company's ratios, right? So these ratios can be calculated moving forward. So we can actually create, based on a moving data, if you will, we can create maybe 3, 4, 5 years of financial statements in the future. So now we can say, well, what happens to the company in 5 years if I change, let's just pick a ratio. We want the days sales outstanding, we want that number to go from 36, we want that number to be 25. How is that going to affect the financial viability of the company? So we can look at the strategic plan and we can implement it, if you will, on paper and see what that will ultimately do to the value, to the company's financial strengths and weaknesses. And we can obviously plan to make changes. So that's the basis of the long-term financial planning of a company.